Well, hello and welcome to our live BUSS2 revision session, which we're going to do looking at finance and operations sections of the BUSS2 exam. We're going to follow the similar format that we've used for all our BeeBusinessBee formats so far. So we're going to start off by looking at an outline of the session. So what we're going to do is look at what the requirements are for your BUSS2 exam. We're then going to look at using budgets, how you improve cash flow, measuring and increasing profit, quality of operations and decision making, customer service, suppliers and technology in operations, before I give you the chance to ask any questions, which you can do all the way through if you just tweet at BeeBusinessBee, and I should pick them all up for you. Okay, we're just going to start off by looking at the requirements of the BUSS2 exam. This is what's called the Managing Business paper. It's worth 60% of your AS and 30% of your A-level paper. It's 1 hour and 30-minute examination worth 80 marks, which comprises of 2 case studies and multi-part response questions. So it's a more challenging paper, but more important for your scoring the points in your exam. So if your BUSS1 exam hasn't gone as well as you want to, this is when you make it up. If you're resitting, it's quite an important one for your A-level grades. Okay, we're going to move on and start by looking at using budgets. Now, I call this part 2 because this is following on from what you should know from BUSS1. Okay, you should already know that a budget is a plan that establishes the expected revenue and expenditure within an organisation. So that's the common knowledge. You should know that it's a plan for what you want to spend or you're going to receive. There are 3 different types of budget you should know about. You should know about the income budget, and this shows the planned inflows into the organisation over a period of time. You should know about the expenditure budget, which shows the planned outflows of an organisation over a period of time. And you should know about a profit budget, which basically shows you how much predicted profit an organisation is going to make. It will be your income budget less your expenditure budget, which will show your profit budget. Within budgeting, you should have an understanding of what makes a good budget. So within a good budget, it should have and be in keeping with the aims of the organisation, so it fits in with what the business aims are. It should be based on the opinions of as many people as possible, so you should try and tap into the expertise of people if you can within your organisation. You should set, which is called realistic targets or SMART targets, so making sure they are actually achievable, so they actually motivate and they don't demotivate people. Now, within your budget analysis, you're meant to know about this thing called variance, and you could be asked to calculate this. Now, variance analysis is where the actual figures are compared to those that were budgeted for. So you are comparing your figures. You will have 2 types of variance. You will have what's known as an adverse variance and a favourable variance. So if we go into more detail now and look at what these mean, hopefully you'll understand them. So an adverse variance is where a business will do worse than it is expected. So this would actually mean in real terms that your costs were higher than you budgeted for, or your actual revenue was lower than you budgeted for. So remember, in an adverse situation, you've done worse than you expected. So your budget was for, let's say, £1,000 of revenue, but you actually only achieved £900. That's doing worse. Or on the other side, let's say that you thought you would spend £100 on costs, but you actually spent £140 on costs. Remember, it's doing worse than you expected. Now, the opposite of an adverse variance is actually what we call a favourable variance. And this is where you do better than expected. So this is where an organisation will actually see that costs were lower than they planned for, or revenue was higher than they budgeted for. So, for example, in this case here, let's say that we budgeted again for our cost to be £50. But actually, we only spent £40. That means we did better. It's more favourable. It's in our favour. Or in this case, of course, we may say that we budgeted for revenue to be £200, but we actually achieved £220 of sales. And because of that, our sales revenue is better. We have got a more favourable variance. So you need to be able to be au fait with those terms, adverse and favourable. So let's have a look at what it means. So, as you see on your screen now, you've got a budget. And you've got the actual figures. As you can see over here, if I just get my little mouse, there we go. You've got a revenue of 1.4 million on the budget, and you've got an actual of 1.3. You've got an expenditure on the budget of 0.9, and you've got an expenditure on the actual of 0.7. And profitability-wise, 0.5 million and 0.6. what I want you to do really quickly is just think, were they adverse, were they favourable? Do it for each column. So was the revenue column worse or better than expected? So is that adverse or favourable? And then do the same for your expenditure budget. So worse than better than expected, and then think about your adverse or favourable. And then do the same for profit as well. So worse than better than expected, and then think about it's adverse or favourable. Just give you a few minutes, well, a few minutes, give you a few seconds to think about that. So adverse or favourable for each column, and then let's move and have a look at the answers. Okay, hopefully you've worked out the answers are going to be as follows. The revenue column was adverse. It was worse than expected. As you can see, they planned for 1.4, but they only made 1.3. So it's adverse. However, their expenditure was actually favourable because they planned to spend 0.9 million, but they actually only spent 0.7 million. So they did a lot better than expected. And their profitability, they planned for 0.5, but they actually made 0.6 million. So that's favourable. They did better than they expected. And that is how you would calculate variance. Okay, hopefully you've got an understanding of that. If you're a little bit unsure, send me a tweet. It's at BeeBusinessBee, and I'll take your questions via Twitter. No problems about that at all. Just tweet me away and I'll answer your questions. Otherwise, we're going to move on to our next topic, which will be improving cash flow. Okay, so improving cash flow is our next topic. What we're going to look at here is basically what is cash flow. Just a quick recap from BUSS1, and then we're going to look at how you improve cash flow for a business organization. Okay, so remember, cash flow is like my bathtub example that I've drawn before. I know some of you love that little bathtub I've used before. It is the money that flows into and out of a business. A cash flow forecast is a prediction, where a cash flow statement is the actual money that flows in and out of a business. Typically, managers, owners, and lenders use a cash flow forecast. So your managers and your owners are typically going to use it to make assessments on how well the organisation is performing and the liquidity situation of the organisation. Has it got enough money into the day-to-day to run it, or does it need to look to take out some sources of short-term borrowing or maybe even long-term borrowing? Where a lender will be looking to see if they can service those debts, so pay them back. So is the organisation able to pay that money back that it's going to borrow? Because if it can't, then there's no point lending that money at all. So we need to think about the two solutions. Now remember, this is recap really. Two solutions you should know straight away because I've taught you these. Think about the tap and the plug hole. It's dead simple. You are literally either going to increase your sales revenue, so you're going to bring in more money. Now remember, cold water tap, you're going to run more sales revenue into your bathtub because that's good for your business, not borrow money because that's a hot water tap, remember. Or you're going to reduce your costs, so shrink the size of your plug hole. Those are the only two ways to solve a cash flow problem. No other way. You are purely going to solve a cash flow problem by increasing sales revenue, reducing costs. Nothing else will solve a cash flow problem. Everything else will make it worse. If you're unsure on this, have a look back at my BUSS1 video on cash flow, where I've drawn a little bathtub, and hopefully that'll make sense to you on where I'm coming from that idea. Okay, you're meant to know common causes of cash flow problems. And hopefully you're fairly au fait with them come from on these ones here. So typically you may get seasonality. So if it's an ice cream business, for example, you're going to have seasonality where they'll sell more ice creams in summer. So you'd expect their cash flow to be positive in summer and maybe negative in a winter. So that's when they're going to have problems. Again, you probably get that in fashion. So Christmas time you may sell more items, or in the summer when it's in season, but you will sell it off season, you'll have a quieter period. Poor financial planning, that's one of the common problems you have, where managers and owners have not conducted a cash flow problem. Typically in an exam case study, this has come before, where you're looking at somebody hasn't conducted a proper financial plan, and as a result their business is failing. So again, managing your flows of money, so making sure that you've got money coming in and money going out, and collecting your debt. So there we go. So poor debtor management. So taking too long to collect the money off people who owe you money. Remember, they're a debtor. People who owe you money are called a debtor. Taking too long. Also, it could be poor creditor manager, which means, in other words, taking too short a period to pay the people you actually owe, your suppliers. So in this case here, you'll probably pay them after maybe 3 or 4 days, for example, rather than paying them on 30 days or 60 days. In an ideal world, what you want is you want your debtors to pay you, for example, in 30 days, and you will pay your creditors in 60 days. Because that means you've got 30 days of that money is in your bank account gaining interest. So you're going to make more money back, in theory, off that money. It's just resting your account through interest at the bank. And overheads become unmanageable. Some organisations take out or start spending on large overheads, and then of course they become unmanageable because they can't afford to pay for them. So maybe they need to cut their overheads back. So let's look at example cash flow and look at what you can do. So this is a business that you can see here. This is our cash flow here. So you can see that. How is the business performing? Well, if you want to look at the net monthly, which probably shows you what's happening each month, it's not doing the best. It starts off here with a positive figure, and it seems to get negative. It starts to improve a little bit, but overall you can see that down here the closing balance is actually getting worse all the time as well. So even though things are starting to get more positive, it's starting to get a smaller loss each month, it's still getting more and more to debt by the closing balance, and that's going to be borrowed money. It's going to cost money. Short-term loan overdraft. Notice the first month in January it's propped up by a bank loan and personal investment. So what we're going to do is look at some of the different effects on the cash flow. Let's have a look at what happens. So if we increase our selling price, what's going to happen to our cash flow? Well, hopefully you can see straight away things start to pick up a bit quicker. These figures now are going to positive. Look at this, it's going to positive much quicker now. And look at the overall closing balance. Things are starting to pick up. We're not borrowing as much money now at the end of each month. The overdraft has got smaller. We're not borrowing the £5 grand anymore now. We're down to this here. However, what's the drawback increase in our selling price? Well, I can hear you all shouting across the Twitter sphere now that you're telling me that basically you're going to lose potential customers. Some people will not buy our items. This depends on the elasticity of our product, isn't it? The price elasticity. Is our product elastic? If it's elastic, then we're going to lose sales. If it's inelastic, then, well, the actual drawbacks are going to be minimal on that side. But, of course, it does affect us that way. Okay, as you can see, that's one option. So let's try and combine this with another option. We've tried to increase our revenue there, so getting more revenue. Let's do the other option. Let's try and reduce our costs. So let's find a cheaper supplier. So here we go. We've got a cheaper supplier. As you can see now, things are getting more positive in this case here. We're now getting 2 months of positivity, and our debts are coming down each month here. And if you notice here, look at this. We're getting down even further from our £5 grand. We're now down to that. Everything's looking positive. Our cost of sales has come down because we've got a cheaper supplier. However, what's the drawbacks of getting a cheaper supplier? Again, I can hear you across the Twitter sphere telling me that the drawbacks of a cheaper supplier could be a reduction in quality. It could damage our reputation. It could damage our brand loyalty. And ultimately, it could actually hinder our sales and we'll make less sales. So that's how we get our evaluation in there. Now, one of the other options you could do is, if you notice this business at the moment, we're paying a salary. Now, remember, salaries are fixed costs. So we're paying the same amount all the time. But with it being a new business, maybe we want to start paying a wage to start with. So when we're working less hours to start with, we're not paying as much out. So let's look how that works. If we then change our salary to a wage, as you can see there, look how it affects us now. All of a sudden, we have a massive change. We're in a positive down here. We always close in a positive. We're not borrowing on an overdraft now at this point here. And if you notice each month, look at this, we're not making as big a loss anymore each month on our net monthly. So things are starting to show signs of improvement here in our cash flow. We've got a positive cash flow all the way through the business. So this is where it suddenly changes, all because we started paying by the number of hours we do. Of course, what's the problem with paying a wage all the time? Well, of course, as we work more and more hours, we're going to pay more and more money out. And of course, in the long term, it may not be sustainable to pay a wage all the way through. Of course, it may not even motivate. Some people don't want to be earning a wage. Some people want the security of a salary that they earn. And of course, the other option is, which I probably guess that some of you spotted straight away, is why take money from the bank where you're going to pay interest when you can invest your own money? Now, of course, this is an opportunity cost. So the opportunity is going to go because he's going to use that money to spend it on the business rather than something else. So remember, opportunity cost is a cost of the next best alternative. So in this case here now, he's investing his £2 grand in the business, but he's not borrowing from the bank, so he's got no interest charges. So, of course, this makes this a bit more positive down here. Net monthly is not as bad as it was. Look, he's getting more money coming in. He's reduced his bill by £20 on interest payments. But also, down here, it's looking much more positive because he's not borrowing any money. It's all his own cash. He's invested it. He's not got to pay it back to anybody else. He's got no responsibility doing that. But like I say, the opportunity cost of the fact is that he's given that up now. He's put it in the business. And another drawback is the fact that maybe if he needs a large scale of investment, he actually hasn't got that money to invest in his business. Of course, there may be other solutions that you want to use. I'll try to demonstrate it by showing you on a cash flow some changes there to try and give you an indication of how it works. But you could actually, in theory, use an overdraft. So on our business we saw a minute ago, he would have used an overdraft for those short-term problems. Remember, though, you never use an overdraft for long-term cash flow problems because it's vastly expensive compared to a loan. It's a surefire way to cause a liquidity problem if you're going to rely on that for long-term borrowing. Overdraft short-term, remember, less than 1 year. Or if you're going to do anything else, take out a loan. You could take out a short-term loan if you want to just cover something for a short period of time. Again, though, tends to have a lower rate of interest than an overdraft, but it's still a loan. It still comes with a charge, a cost of interest. You could adopt the policy of selling off your assets. Now, this is a great way of raising finance in the short term because you're selling off things you own. So you're selling off your own assets. Fantastic. Because in this case here, you're raising money through what you've got in your organization. It works if you're selling off things you're not using. If you're going to start selling off your machinery and your computers because you need to raise money and you use them on a daily basis, well, that's actually not a good idea, is it? That's like retrenching, only putting yourself out of business because you're actually selling off your own assets. This is why some people go for this option of sale and lease back, where you sell off your assets and then lease it back. So you're going to get a short-term injection of cash. Now remember, because you're selling it off, you're not going to get the same amount of money. If you bought it for £1,000, you're only going to get perhaps £400, £500 back from it anyway. So, but the fact is you get to lease it back. And of course then you get to keep control and use it. However, the problem here is you're going to pay more back in the long term because you're leasing. So when you lease something, you're going to pay for it in the long term. So bear that in mind. It's never yours. You've lost an asset really in that sense. So your business is actually giving away some of its assets, but it's going to pay leases. Good example of this is lots of high street stores have done this. But of course Woolworths did this. And then you know what happened to Woolworths? They went bankrupt because of a liquidity problem because they couldn't afford to pay the lease on the buildings they once used to own. Or you could adopt what came up last year in the exam, debt factoring. And debt factoring is a fancy word for selling your debt. I've done a PowerPoint presentation on this somewhere, I think on YouTube, where I've shown you what debt factoring is and how it works. It might be worth checking it out on my channel rather than trying to explain it on here. But debt factoring is when you sell off your debts to people. Remember, this will only normally happen if you've got poor cash flow and debt management. So you should be chasing people up. These debtors that owe you money. If you get it in on time, you shouldn't really need to use debt factoring. It's one of those things that you only need to use when you've allowed lots of bad debts to occur and you've got a cash flow problem emerging. Okay, that should now have covered the topic of cash flow, and we're going to be moving on to measuring and increasing profits. If you've got any questions, feel free to tweet them away at BeeBusinessBee, and I'll pick them up and I'll answer them for you. And otherwise, we'll move on in a minute to the next part. Just give you a minute just to think about if you've got any questions. Remember, at BeeBusinessBee, tweet them off to me. Okay, right then, let's move on to managing and increasing profit. So you get right, measuring and increasing profit. I can't read. The BeeBusinessBee has lost his ability to read. That's not the cleverest idea, is it? What a silly sausage the BeeBusinessBee is. Must tell myself off. I'll go back into my hive later because that's really bad of myself. Anyway, let's get rocking and rolling. Don't want to distract you from your revision. It's all about getting on with this. As you know, we're key to the point to get moving. So let's have a look at this. Right, we're going to go back straight away to the obvious stuff you should know already. Right. Already, you should know that profit is revenue minus costs. You should know that gross profit is calculated by doing revenue minus the cost of sales. And you should be aware that gross profit is what you make on each item you sell. You should also be aware that net profit is revenue minus all costs. And of course, net profit is the final profit you get to keep. So it's the one you take home with you. And you should be well aware this is always going to be smaller than gross. Remember, gross is big fat profit. Whereas net is a smaller profit, the one you make at the end. So there we go. That's nice and simple. Hopefully, none of you are thinking that's too complex because that's all BUSS1 paper. Now we're going to take it a bit further. Let's have a look at the next part. So this is what you need to know for your exam now in BUSS2, net profit margin. The net profit margin is the amount of profit that an organisation makes expressed as a percentage. So this is what you make as a company in a percent. So what percent you made, and you calculate this, and you've got to know this formula. Net profit divided by turnover times 100. So you need to probably write it down and make sure you note for your exam. You could be expected to use it, and you've seen that exam paper this year. You know it's been quite mathematical. Maybe it'll be the same again. So net profit divided by turnover times 100. Those figures will all be in the case study if you need to lift them out or in a table somewhere. Now the net profit margin, right, should be basically the smaller profit, right? So it tells you how the organisation is performing. So in theory, the bigger the profit margin, the better the business is doing. Remember, it's going to be smaller than your gross profit. So, but it should be a higher figure. So if you've got a figure, for example, of 40%, that is better than 20%, right? You need to pick this information out from either the table or the income statement, typically, right? Now, think about this logically. There, you've got an example there. You've got 80,000 there, so divided by 6 million, so your net profit is 80,000, your turnover is 6 million, and then you times it by 100, and you get a figure of 1.33%. How would you think that business is performing? Well, if that's my final figure, would you be happy with that? I'm hoping you'd be saying no, because I think that's pretty shocking. If that was my business, I would not be happy about that. So as you can see, 1.33%, not the best figure. You're probably looking more for about 30 to 50% would be a good margin, a very good margin, really. Realistically, perhaps about 20, 25 would be a good return for what you spend. Okay, the gross margin is actually calculated fairly straightforward. It is dead simple. It's the amount of profit you make on each item that you sell. So think about it, if you like Coca-Cola, every can of Coke you sell, it's a percentage you make on that can. And this is calculated by the gross profit divided by the turnover times 100. Really simple to remember. Remember, the other one was net profit. This one's gross profit divided by turnover times 100. Nothing complex about it. You can do that straight away. It really is as simple as that. So let's take that into our example. The same thing again applies. The greater the gross profit margin, the better the organisation is performing. This should never be a negative. This means you're making a loss on every item you're selling otherwise. So no company should ever have a gross margin of a negative figure. So notice it's got to be bigger than your net profit margin. And if we're doing this again, let's take the figures in that we've got here. So we've got our figure of £3 million gross profit divided by our turnover of £6 million, and that means we're making 50% on every item we sell. So if you were to look at the examples we got a minute ago, we had a net profit of 1.3%, 1.33%, and we had a gross of 50%. That means we're making 50% of every item we sell, but we're only making 1.33% at the end of it all. That tells us that we've got overheads which are crippling this business. We've got loads and loads of fixed costs which are killing the business, strangling it. Because look how it's taking off 50% now to 1.33%. That is making a decision based on the numerical data we've got, which is a high level answer. Another thing you've got to learn for the exam is what's called return on capital. Now you need to know that this is a percentage return you get on the capital you invest in the business. Now typically this is going to be what the owner gets back for the money they invest in their business, and you calculate it by doing what they call net profit divided by the capital invested times 100. That's a formula you have to know again. So remember, net profit divided by capital invested times 100. If you're not au fait with these formulas and you're panicking, go and check out my channel again. I've got a YouTube video again on there which talks you through the formulas for BUSS2, and it gives you a strategy to learn them. If you follow it through, it will work. I've got learners who can testify that it does work. It's a great strategy to learn your formulas if you need to. So remember, you've got to learn these formulas. It could come up again. So how do you increase your profitability? Well, it's pretty obvious, really. You'll know of these things. I mean, you could increase your selling price. But then you've got to think about the other side of the coin. Will it reduce the demand of your product so you'll actually sell less items? And then we get back into the price elasticity. If the product is elastic, then increasing your selling price is probably not a good idea, because it means that you're going to have a more responsive product to a change in price. You don't want that to happen. But if it's inelastic, then yes, that'll work. So you could increase the price of an inelastic product, and it'll probably have an effect on your sales revenue that you're going to bring in. Or you could reduce costs. But the problem with reducing costs is typically it means you're reducing quality. You may then damage your brand reputation. You could even damage the added value that your brand achieves through that reputation it's established. So you've got to consider all these factors, and that's what's the most important part, really, when you think about this. What is going to be the knock-on effect and the damage to the brand that we've got? Okay, so really what we've done there is we've then covered now managing and increasing profit, really, and that is all you need to know for your exam in that section of the course. However, you have to know those formulas, and that covers all the finance section in BUSS2 as well. So notice it's not that complex, apart from memory of the formulas and being able to use the formulas. You need to know the core knowledge and be able to make them evaluative links. We're going to now move on and look at the operational target side. So we're going to look at operations now and take it a little bit further and look at this side of the course. Just give you maybe 30 seconds to ask any questions you may want to so far. Tweet them in. So far, nothing's come through on Twitter. Whether my Twitter sphere is broken, I don't know. Whether nobody's out there actually tweeting me, maybe that's the case. I've been a little bit lonely in my little hive here, but nothing's come through. I've just got a few favourites and a few likes. Don't forget to recommend me, give me a subscription, tick the box below if you enjoy this. If you can enjoy this, I don't know. Enjoy your business revision, and then we'll move on. Just give you another 10 seconds. Okay, let's get moving on then, we might as well. So let's go and have a look at operational targets. So, what is operations first? You should know this. It's one of the functional areas that gets forgotten about. So remember, there's functional areas of things like marketing, finance, human resources, and operations. They're the ones that are talked about in your BUSS2 exam. Functional areas like departments in that sense. So the operational functional area is typically responsible for the production and delivery of the product or service. Now remember, in a shop, this could be the shop floor, the actual staff that work on the shop floor. So bear this in mind. In a service, they actually deliver that service the operations department do. It's quite easy to think about in a factory, but in a business like a shop, you've got to think about the production department are actually responsible for physically delivering that product working on the shop floor. Okay, what operational targets do you tend to find? Well, typically in the operations department, you'll get these targets that are set. They'll either want to reduce costs, and they'll do that by reducing the unit cost per item, which normally means they're going to invest in some sort of machinery and capital-intensive production. They'll either increase the quality of the product, that's what they want to try and normally achieve, but again, they have to cater for the customer's needs and expectations. They will want to improve efficiency, because that's going to save money in the long term, and because it's going to reduce your unit cost. They're going to want to reduce waste, again, it's going to help to achieve that objective of actually reducing waste, and they'll probably want to improve their capacity utilization. So they'll want to get that as close to the 100 figure as possible. Now, of course, that we know the 100 is unrealistic. We'll talk about that in a minute. So we're probably going to be looking for that 93, 94% and get it as close or as high as possible without having that negative impact on the business. If they do all of these, they'll link nicely with the financial objectives, because it's going to increase your profit margins and it's going to enable you to make the business more competitive, so more successful, which is great for a business organization because it's how it fits in nicely with the overall objectives of the company. Of course, we've got to consider the drawbacks of any operational objectives. So if we have a cheaper supplier, we could reduce the quality and the brand image and the brand name and the reputation of the organization. If we want to increase our capacity, then we may have to invest in capital-intensive production, which basically means machinery. Now, the problem with capital-intensive production is, the reason it's called capital-intensive is capital is a big word for money in business terms. You probably worked that out already. And it is vastly expensive to invest in machinery. So you're talking about, in the short term, you may need to borrow the money, or you've got to be a large organisation to be able to afford to do this. It's not a cheap option. Or you could, in theory, if you try shopping around for suppliers, lose a good relationship with suppliers. And let's say you're using a just-in-time method where items are arriving just in time, then you could, in theory, compromise that by looking for a cheaper supplier. You may find something cheaper, but they may not be as reliable, and that may have a knock-on effect on your customer service. Now, one of the formulas you've got to learn on this side of the course is unit costs. Now, you've got to know that to calculate the unit cost, it is really simple to learn the formula, but you could be asked to do this. A unit cost is calculated by doing the total cost divided by the output, so the number of items you make, and then obviously it tells you the cost per item. So in this theory here, let's say that the total cost of the business are £1 million, and they make 60,000 items. If you do the maths, that works out at £16.66 per item. So if you want to lower the unit cost, obviously the idea there is the total cost figure, let's take it down. And if you take it down, then obviously you're going to affect the overall cost per unit, and clearly that makes it more efficient and more profitable for the organisation, because the selling price, for example, might be £20 in that case. But if you can get that unit cost down to £10, then let's say the selling price is 20, then you're suddenly making £10 rather than making £4.42, 44. Get it right? I'm doing maths really. Right, a non-standard order is something which an organisation gets when it's different to what they normally do. It's a special request. This could be making some personalisation, or making some customisation, or making something unique for the organisation. You could be asked reasonably as a long answer question to make a decision on whether you think a business should accept a non-standard order or not. Should they take that order or not? And you need to think about some evaluation points that you can make in there, because you've got to show that you've got an understanding of this. So this question comes up, I would like you to think about things such as, what are the existing skills of the workforce? What's the existing capacity utilisation of the business? So are we using overtime, for example? Now, what's the problem with using overtime? It's expensive, but it also, at the same time, it's a great way of increasing in the short-term period. So at that same point there, we could also link into the fact that if we do it for too much, we might time our workers and demotivate them. But in the short approach, if we go to temporary employees, a great option with that is they're more flexible, but are they trained enough? Have they got the skills of the workforce to do it? And can they deliver the order to the standards required? If they can't, then it's pointless because it's going to damage our reputation. Part-time employees. So we could look at the fact of our employees. We could take some employees on a part-time basis, and then we could hopefully cut their hours down at a later date. So it's sort of 0-hour contracts is more common these days. Again, problem with that is, do we train them? If we train them and they go somewhere else, we get full-time employment, we've lost them. And of course then the opportunity cost of training them has gone, so the theory is we've wasted money there. Or do we adopt the policy of subcontracting? Now, subcontracting is where we give out the order to somebody else, but then we have to think about protectionism, because what's to stop that company from then taking on this order and then approaching our customer and saying we can make the order quicker, cheaper, because we did it before. So you've got to be careful with subcontracting, and it's probably more expensive. They're going to charge a little bit more per item for making it, because they're going to use their skills and their expertise. There's lots of factors to consider there. And also we need to consider the existing production methods we use. For example, if we're being employed to make something on a special order because we're a handcrafted business, if we then start investing in machinery, can we make it? Or vice versa. If we make all of our products normally on a machine and then we're suddenly being asked to make something which requires more hands-on skills, then again, can we make it? How much will it cost to change the machine so that it can actually cater for the requirements of that job? You've got to consider all these factors. It's not as simple as saying we'll take it on because we can make more money per unit. You've got to think about the extra costs that are involved in that. And that actually covers that area of the course. So it's quite a simple little part of the course, you think there. It's not too complex. You've just got to remember your unit cost calculation and think about your non-standard orders. If you've got any questions, remember, tweet me at BeeBusinessBee and I'll pick them up. So far, nice and quiet on the tweets. I don't know why. So surprised at that. Remember, you can tweet me any point you want, even if you are watching this on catch-up. It's not a problem. And then we're going to move on to our effective operations, looking at quality in a minute. Okay, well, let's move on and have a look at quality. So, the first thing to say to you is, just to get in your mind, a quality product is one that meets customers' expectations and is fit for purpose. Remember that, right? A quality product doesn't actually have to be the best, so long as it meets the needs of the customers. I know that sounds bizarre, because a customer is going to perceive quality as meeting their expectations, what they think quality is. So if you shop in Poundland, you're not expecting gold. So as long as it meets your expectations, as long as it does what it says on the tin, you're happy. But clearly, if you're shopping for an Audi or a Bentley, you expect it to meet a higher expectation in that sense. So you expect the materials to reflect that. So remember, quality is a product that meets your expectations. It's fit for purpose. Now, within quality, you tend to have this process, what's called quality control. Now, quality control is a way of inspecting the product at the end of the production process. And you would typically do this using a sample of products. And notice that you're checking the quality in this method at the end. So you've got a production line and you go along at the end and you do a sample. You check the quality, you assess it. If it's good, then you move on. If it's not, then you might go back and try and find out where it goes wrong. However, some people argue this creates wastage. So they adopt another policy. Rather than quality control, they've adopted this policy which is called quality assurance. Now, quality assurance is a system that ensures that high quality standards are being met throughout the production process. Now, this means you're not checking at the end, you're checking all the way through. Typically, this involves empowering all your workers. So you need to empower them and give them training to know what a quality product is and what the expectations of the organisation are, and you need to make sure that they feel confident enough to make a decision on what is good and what is not good. But by doing this, in theory, you're going to reduce your waste because you're going to nip things in the bud earlier. And this is where you've got to play them off. There's a choice. You might do quality control, you might do quality assurance. It depends on some of the factors. such as you've got these choices here. Quality control tends to be cheaper in the short term because you're only actually training a few staff to check actually what the product is. So you're doing a bit of training at the end. You're saying to them, this is what's a quality product, you're looking for this, and you give them responsibility to make that decision. So they can be trained, they can make that decision at the end, and because of that, you've got a lot of low-level staff who are just making their product. They don't have to worry about the quality of it, they just keep making it. Somebody at the end just checks it. However, quality control also leads to more wastage, because when it goes wrong, you only spot it going wrong at the end of the cycle. So that, of course, then can increase your unit cost if this is happening too much. Tends to be happens, quality control does, with robotic or automated machinery that produces an item, because you tend to find that once you've got a batch being made, they're all produced to the same standard. Of course, if it goes wrong, then you'll just spot it right at the end of the process. But quality assurance, on the other hand, of course, can be more motivating. Because you're giving workers responsibility, because you're empowering them, you're making them feel better about themselves, giving them more control of what they do, this means that they're more likely to take an interest in the product, and they're going to feel that they've got some more responsibility and attachment to that product. And that's why it's quite good. However, it costs you more money. Responsibility normally tends to mean you've got to pay them more. Quality assurance is also really good for spotting specific problems. So rather than reacting at the end when something's gone wrong, you can be proactive and work out where it's gone wrong. So it tends to be quite a positive method of solving a problem. Now, if you adopt systems of quality assurance, you're said to have this award, which is called the ISO 9000 award. And this is an award that's given to any organisation which has got a quality assurance system in place. Now, to achieve this award, you have to have the following things. You've got to have clear quality targets that are set. So you're setting targets which all your workforce can achieve. They're realistic. You have to have systems in place that check that you're meeting your quality targets. And you have to have some record that measures and records the results of your quality that you've done. You've got to be hot on this idea, right? So ISO 9000 only is awarded to organisations that have got these systems in place. They're really keen on this idea. You've got to consider the following factors, because you can't simply just say one size fits all. It's about the cost of the quality system you've got. So how expensive is your quality system? So have you got a system, can you afford to invest in a quality assurance system? Or are you actually a small business that just needs to rely on the quality control method at the end, just checking? Training requirements. Can you afford to train your staff to know what a good quality product is? Can you afford to empower your staff to make those decisions? Or, again, are you just going to use the owner or the manager to check at the end? The needs of the customer. What does the customer actually need? If quality is the prime selling point of your business, the unique selling point of your product, then yes, you probably need to have a quality assurance system. If it's just purely a batch-made product, then maybe actually you only need to use quality control. The impact on your selling price. If you're in a highly competitive market and you need to get the unit cost as low as possible and you can't really afford to adjust your selling price and your profit margins are quite tight. Oh, I see we've lost. Hopefully we're back on again. I think we're back on. Let me just show you there. Sorry about that. I'm hoping we're back. Just bear with me. I think the screen's coming back to you in a minute. It says famous last words. Click that button there. I'm hoping you can see my screen. It's still gone blank on my screen there. There you go. Come back to you, hopefully. As I was saying, hopefully we're doing really well there. No technical gremlins, and then of course, lo and behold, the technical gremlin hits us there straight away. So that's our first one of the day. What a shame, but there we go. So hopefully this will come back to us. He says, famous last words. Are we going to come back on your screen? Can you see me? Yes, you can. Right, okay, let's move back on. So the impact on your unique selling point, as I said before, or the impact on your competitiveness. So how competitive can you be as a business? Can you afford to actually make that choice? Okay, we've gone again. Are we back? Yeah, we're back again. Excellent, that's good. Right, okay, so moving on there. So let's have a look at our next area, which is actually what we're going to look at, what's called customer service. Again, another element of the course which is quite important to get your head around. Now, customer service, common to what you may think, is actually takes place before, during, and after the purchase of the product. And it's basically ensuring that your purchase that you're giving the customer what the customer makes in you actually meets the needs and expectations of the customers. That's really important. So customer service is basically making sure your customer is satisfied with what they've done, not only at the time of purchase, but before, during, and after, and you're meeting their expectations. Remember that, it's really important. So customer service, typical examples you got like offering pre-sales advice, so offering some advice before you sell the product, making sure the customer is purchasing the right product, so ensuring you're meeting their needs. Maybe talking to them, find out what they actually need the product for. Not trying to sell them the most expensive item, but trying to sell them the one that meets their needs. If you do this properly, you'll get some repeat business, some loyalty out of them, and get a good brand reputation and image, rather than just one short-term sale. You may have helplines that help them after they purchase. If they get stuck, they can ring up and they can sort out their problems, no problem at all, and it'll hopefully solve any of their potential problems they've got. And again, it helps to build the image of the organisation, make them feel better about themselves. And of course, you could, and you should as well, deal with customer issues fairly successfully. Let's be honest, we all know that things will go wrong sometimes, but it's how the business responds to those issues that will make a difference about how the customer perceives the problem and what the company does. So they should have a good system to deal with customer complaints, because that can make a real difference. They always say that one unhappy customer will tell 20 people, whereas one happy customer will only tell one more customer. So it's really important that you protect your brand image by ensuring you deal with customers fairly and accurately. Now, how do you go about meeting the expectations of the customer? Well, you typically carry out some market research. So you might do a survey, a questionnaire, or a focus group. So that tends to be normally primary market research. You find out. Remember, focus groups are where you get people in a room and you ask them for opinions. Surveys and questionnaires tend to be done either at the point of purchase when you're buying the item, or maybe afterwards, following it up. You can do them in different ways. Every company has different ways of doing it. Some are even doing text message surveys these days when they've got your detail. Nice and easy, instantaneous replying. Training. Make sure your staff actually know what good customer service is. A lot of staff are not trained. They don't know what makes good customer service. So ensure your staff actually know what makes good customer service. And quality assurance and control. Making sure you've got that system in place that says it's right the first time. You're getting the actual thing right the first time you do it. You don't want it to go wrong and then having to go back over and over again to solve the problem. So it's important to monitor your customer service. Typically, like we say, you do these satisfaction surveys, so you text it out or you give them a little questionnaire to fill in. You may ask them to join a focus group, to sit around a room and show them some of your brands and your products and get them to tell you some feedback on what they thought about it, or watch some videos back. You may even get them, your workers, your employees, to sit around the room and watch a sale back over a CCTV camera and see how they thought it went. Tracking surveys can be used where you basically keep tracking the customer throughout their purchase. If they buy a car, you might phone them the first week, the first month, the first 6 months, the first year, see what their opinions are, trying to build that relationship, keep it going, because you know that the customer is more likely to come back to you. That will save you on the marketing costs of your business as well. It's really, really handy. And of course, online or mobile surveys are more common these days, which we said about before, about how they text or they interact with you through the internet, which makes it cheaper as well, easy to graph and analyze. Okay, typically an organization can improve its customer service because it intends to want to value its customers, so it'll look after. If you value your customers, typically more customers will come back to you. If you improve the speed of your service, customers are going to come to your business hopefully and recommend your business. If your staff are friendly and appear that they actually have an interest in the business, they're going to come back to you. If you are efficient with dealing with those issues when things go wrong, your customers are going to come back to you. Even though it's gone wrong, they're more likely to come back to you because they feel that you deal with problems. If your staff are well trained and competent, your staff will probably return to you. They'll come back to you. And of course, if you improve the quality of the product or the service, your staff are more likely to ensure that your customers are going to come back to you because they see the whole vision and they see the whole idea of the company is fantastic and they want to come back and have more of that. They're ready to buy into the vision that you're giving them. Again, so that's really, really important. That's how you improve your customer service. Okay, give you a few minutes to think about that, what we just done there. Got any questions, tweet away, no problems. We're going to look at working with suppliers. So we're coming towards the end now. We've got this one, then we're going to look at technology, and then we'll be done. So on this first section. I know it's been quite quick, but obviously, as you know, BeeBusinessBee resources, I'm trying to give you the key information. You can watch it back at any time, make some notes, and summarize it all. Let's go straight into the suppliers then, shall we? So, a supplier. These are the people who provide your organisation with a product or service. They can be businesses, they can be individuals. You typically need to build up a good relationship with your supplier. Suppliers are normally critical to the overall success of your business. Without suppliers, then your business may be destined to fail, because you need to ensure your suppliers buy into your vision and you've got that relationship with them that they can meet your needs, your customers. When you choose a supplier, fundamentally you're going to look at the quality of the materials or the service they provide. You want somebody who's reliable and somebody who can give you good quality products. Remember, that helps to meet those customer service expectations that they've got. You need somebody probably who's going to be flexible, who can respond to short-term changes. So if you have an increase in demand from your customers, they can supply you with the goods at the required time frame to help you do it. Ultimately, you need value for money. You're going to be looking for the cost of the raw materials and cost of the products. So you are actually going to look for that. You are going to look to try and get value for money, get a return that's going to lower the unit cost. You may be looking for somebody who's going to invest in technology, because you may be looking for a supplier who actually can buy into a JIT system, because a JIT system is fantastic normally for saving money, which is a great way of course, adopting a policy which could be more flexible and more reliable in the long term, or even reduce your unit costs. Or you could look for a supplier who's got better payment terms, so they give you longer creditor days to pay. So they might give you 60 days or 90 days. Again, it could be important to look at if you've got cash flow considerations. You may look to change supplier purely because of the cash flow position of the organisation. So, a good supplier for your business should, in theory, enable you to improve your customer service. It should enable you to deliver your goods on time, ensuring a good quality product that actually meets the needs of the customer. It should enable you to get a discount through economies of scale, through getting reduced costs, so reducing your unit cost. It should enable you to be flexible, so that you can deal with any short-term change in demand, any requests from your customers that are going to be short-term, any special orders that come this way. You need to have your suppliers that can be able to cater for that. And that is really the area of suppliers. Notice all the links that go across operations there. Suppliers is a short topic, but it links across the board. And of course, last but not least in today's session, we're going to look at technology. Quite an intense part of the course. So let's cover this now, and let's have a look at technology. A little area of the course that we need to cover, really. Quite an important part. Okay. Technology. You need to be aware of different types of technology that exist in business. Now, one of the types of technology you've got to know about is robotics. Now, robotics tends to be the production process, which is called CAM, Computer-Aided Manufacturing. Typical advantages of CAM tend to be that you can increase your production speed, you can improve your quality, so as a result you're going to lower your unit cost. You can actually make more, so your quantity is actually increased. Your workers don't get bored, because obviously this is run by machinery, so they can do the same job over and over again nice and quickly. They don't take breaks, unlike workers. However, it can be very expensive to purchase the machinery. It's not very flexible, and of course it could demotivate your existing employees, because how they start to see that you've got machinery, they start to feel that actually what's happening, ironically, is your business is going to slowly get rid of them because they're an expensive resource, employees are, and you're going to replace them with more machinery. And of course machinery is not as flexible as workers, because you can't suddenly add new tools to them without having to spend lots of money. So remember, the sources of finance come in here with expensive to purchase. You've got to think about your sources of finance. Oh, gone too far there. Doesn't matter, I'll go to this one there. Another source of technology could be what's called automated stock control, or just-in-time, JIT. I'm going to put you a separate resource on for JIT to explain JIT, so don't worry, but it's basically where the items arrive in the shop just in time. It's a whole process, so you order and it arrives just in time. So say shop, it could be any business at all. So you order and it arrives just when you need it. Just in time is fantastic because it reduces waste, it reduces storage space, it improves your cash flow because you don't need to buy as much stock or hold as much stock, and it's more accurate for your sales forecasting. However, it's expensive to set up, it's dependent on a good supply relationship, and it also takes into account external factors like traffic. So, you know, if you're relying on goods to be delivered, you need good infrastructure, good traffic, good links, obviously, to get there. If you've got traffic jams, they're going to slow your business down. That's a problem. If you haven't got a supplier who's got the accurate infrastructure on the internet, for example, to do the catering for the computer system, again, that's a problem. And you need them to invest in technology. So it tends to be, again, you need a partnership in this case here. But it's a fantastic way. Like I said, I'll explain that more in a separate PowerPoint. I think it's a complex area that I'll explain. Communication technology. So you've got your Email and internet, you've all seen this. It's a great little tool. It reduces wastage, it increases efficiency, it improves the communication channels in an organization. So it means that you can actually get a message out much quicker to your organization. And of course, it improves the opportunities for outsourcing for other countries or other areas of the country if you want to. It's a fantastic little resource and tool that you can use all the time. Of course, though, with all these things, you've got to train your staff. So by training your staff, it comes to a problem. So you've got to think about how do you train your staff, how do you train your organization. You've got to consider the cost of investing in new equipment. So buying that computer systems is going to cost you vast sums of money normally. And of course, you've got to consider about managing it. So how do you manage the systems in place to ensure that workers are not abusing the IT systems? So again, just because it increases efficiency and reduces wastage technological wise, does it do that in the long term when you think about the fact that the time they could waste on a computer? Okay, so then of course you've got your last method, which is called design technology, which of course is like your CAD, your computer aided design. CAD is fantastic because it enables more efficient systems. It enables you to be more competitive and designer. Of course, it's fantastic in that sense because of course you can design products and then turn them into production really, really quickly, and you don't need to make a physical prototype normally, so you're not spending money on doing that. However, you do need to reduce the training costs because you've got to think about training for your employees. So are they trained in CAD and CAM? If you need to bring in a specialist, it's going to cost you lots of money on consultancy. You've got to consider the cost of investing in the software in the first place. So it's really expensive normally to buy CAD software, and of course you may be using off-the-shelf software which actually is vastly expensive and your rivals are using it anyway, so you're not getting a competitive advantage in that method at all by using that software. Of course, overall, the benefits of technology tend to be for businesses that they reduce the unit costs, they tend to see improved communication channels because of the email, they tend to see in quicker operation processes because of technology. They can make products from prototype to production quicker, they improve the customer service levels offered, they improve the quality of the end product, and of course they reduce the amount of waste they produce in a business. All these tend to see increased profitability and improve quality. Okay, that is it. Thankfully, we've got to the end of it all. Hopefully you've enjoyed this session, you found it useful. Take your own notes, like I say, go back through again, watch it again in your own time, recommend me to friends. Give me a follow on at BeeBusinessBee. Subscribe to my YouTube channel and obviously check out my website, BeeBusinessBee.co. Like I say, I've got another session on Friday, which is going to be the second half of this course. I'm going to hang around now. If you want to ask me any questions, feel free, and I'll answer them back to you in a minute, like you say. So just feel free to tweet me away, and I'll get back to your questions, either via this method or via Twitter. Okay, it appears that we've had no questions. Nobody asked any questions, so at that point there, I'll just leave it there and say thank you for joining me today. Remember, you can check out any resource I've got on my website, and hopefully that session has been useful for you. Thanks very much.